Have you ever heard stories about how rich people are using crazy loopholes to pay no tax or maybe cents in the dollar? We're going to be talking today about asset washing. Now, there's a lot of articles from the ATO and some really good pundit articles as well about how they're cleaning up the dirty laundry about asset washing. And it's really good to understand what asset washing is. Now, every Tom, Dick and Harry at a barbecue that thinks they're half a brain about financial literacy, or who have thought that they've saved a huge amount of tax and they're telling you about all the loopholes that they've used, they're the most dangerous people to listen to. Asset washing is more common than you think, and it's a conversation that I have with clients on a daily basis who read something on a forum that a person they don't know had a friend that a cousin accountant was helping them do the work for that allowed them to save a huge amount of tax. Follow that timeline of events, follow that timeline of people, and you'll come back to hearing and me saying that it's a bunch of crap. Now, in this episode, I'm going to tell you about what asset washing actually is, why people think they can use it, and what the ATO is actually doing about it.
Everything school should have taught you in one place. With a property portfolio of over 17 million and an accountancy firm of over 16,000 clients, as well as being an accountant to some of the wealthiest people in Australia, Jeremy Iannuzzelli will be sharing his lessons on everything school should have taught you so you can build the life you want.
Now, asset washing is quite common in the industry, and I've come across accountants, believe it or not, who have advised their clients to do it, not actually understanding the implications involved. But essentially, I'm going to explain to you in short what it actually means. I'm going to try to illustrate it because I'm a big fan of diagrams where I possibly can. But let's say, for instance, you have sold an investment property, and typically this is where I see the scenario that people have spoken to a cousin's friend whose uncle told them 10 years ago about how he did it. But typically they've sold an investment property and they've made, for argument's sake, $150,000 as a capital gain. Now, they're looking for opportunities to minimize the tax on their capital gain. We all want to, and that's my role as an accountant, to try to minimize the tax where we possibly can within all the legal parameters and legislation available to us. Now, uncle's friend's cousin's accountant who assisted him many years ago told him, hey, you've got some shares that are currently sitting on a 100K loss. Now, all well and good, very smart, and I'd be educating the client on the same thing. Sell your shares that you've made a $100,000 loss on if you feel that there's no growth left in them and you're sitting on a donkey. In most cases, that's it. You've sold the shares, made a $100,000 loss, made a capital gain of $150,000. Now you've got a net capital gain of 50 grand, which may be applicable to a 50% discount, saving you further tax, or if you've held the asset for longer than 12 months, there's no discount applicable. What your mate's uncle's brother's accountant told him to do 10 years ago, he goes and says, hey, go buy back those shares at the same price you sold them for within, say, about a couple of days. And that way you're crystallizing the capital loss of 100 grand. So you get to claim it as a capital loss, reducing your tax, but you still get to own those shares. So, hey, if they go up by $100,000, brilliant, you haven't lost anything. That is the definition of asset washing. Now, the ATO are very strict on it, and they generally put about a 30 to 45 day period. If you are selling shares for the purpose of receiving a tax benefit, all well and good, that's fine, no issues. But then rebuying those shares back within the, say, a 30 to 45 day period, you've just taken part in asset washing. Now, the ATO will then go ahead and deny that $100,000 capital loss that you're trying to reduce your tax bill by. So it's very important. The ATO are now looking at this more carefully, considering lots of people are making capital gains in the property space or even capital gains in the share space. The ATO are very linked and very aware with all of the platforms that people are buying and selling shares on. As an accountant, I get to see when you've sold those shares, at what date the contract price was, what proceeds they were. And believe it or not, they also have the ability in collecting a lot more data to be able to see when you're buying the shares as well. From a property perspective, we can see the contract date, we can see the settlement date, and we can also see the sale proceeds as well from a property perspective. So the ATO are becoming very more intuitive and understanding a hell of a lot more about the data they're capturing from all the financial institutions. So it's very important that you understand if you've made a capital gain of $150,000 in this particular example or situation. You've then are sitting on shares, for argument's sake, and it could be any assets. It could be, cryptocurrency, or it could be bonds if you're doing bond trading. It could be other sales of antiquities, for argument's sake, that you're holding on capital account. But in this particular case, you've sold the shares at $100,000 and made a loss, and then you've rebought those shares. And I'm just going to write that down here. Repurchase those shares within, say, a 45-day period for the same price, or relatively the same price that you sold it as. You are partaking in an asset washing scheme, which the ATO will pick you up, will deny that $100,000 loss, and you'll be back to paying capital gain tax on your $150,000 capital gain. The ATO are airing the dirty laundry on this using sophisticated systems. The ATO Commissioner has said it's urging taxpayers, and I'm just reading here directly off the ATO website, they're urging taxpayers to not engage in this particular behaviour. There's a lot of social media warriors out there and self-proclaimed financial experts who are actually encouraging people to partake in asset washing under the guise of very good tax planning. I urge you that their word and their wit carries as much credibility as that lovely statue that's sitting on my table. So be very careful when you're listening to all these self-proclaimed experts who are not tax agents or accountants, all these financial experts who have apparently been doing this for the last 10 years that they've heard from their cousin's brother, uncle that did the tax return 10 years ago. Don't partake in this particular behaviour. The ATO are looking for it. They've got sophisticated tools which they're capturing people on, and accept the benefit that you're getting. Sometimes you don't want to push the needle too far. Getting a $100,000 loss going against a $150,000 capital gain, a bit being unfortunately that you did lose the money in the first place. To me, that's a little bit of a silver lining on a situation. Ideally, as an investor myself, we never want to lose any money, but if there is an opportunity where you can capitalize or crystallize a capital loss, in this particular case selling shares at a loss because you feel they're a donkey, they're not going to go up and you just want to get rid of them from the portfolio, it could be a great opportunity to do that in line with minimizing the tax on the capital gain that you made. This is a short summary on asset washing. I'm Jeremy Iannuzzelli, and this is what schools should have taught you.